Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser, and here we are heading into the middle of April already, which brings us smack dab in the middle of earnings season. And so today we're going to talk a little bit about the market. We haven't seen really significant changes over the past few weeks of what we've already been discussing. But there is a lot of other kind of like fundamental issues that are going on that ultimately does drive the market. So today we're going to get into some of those things. So earnings season, as you may recall, this is where companies come back and they report about their earning expectations. Did they beat or meet what was projected for their earnings for the prior quarter? And more importantly, they give their forward-looking guidance. So what do they expect for next quarter? What do they expect for the rest of the year? And it's supposed to give investors kind of like the information they need to know about making additional investments into a company and looking at things like valuations. And so the idea is companies are hoping that they'll be able to meet or beat their expectations first on what they expect to be able to do based upon what was said last quarter, as well as what analysts are saying. And so we're in earnings season. It really is kind of kicking off this week. And so tomorrow, today's Tuesday, tomorrow, Wednesday, we got Bed Bath & Beyond, one of my favorite places to be, Goldman Sachs, Wells Fargo, and then really the week gets a little more packed looking at Thursday and Friday. Friday is significantly tilted towards financial institutions. We expect that the financial institutions will probably do very well based upon the activity that happened last quarter. So again, earnings season, it's kind of like an interesting time because markets can be reactive based upon if we get caught up by surprise. Because remember, markets are what they're typically doing is they're pricing in all the information that we already know. So what can either get a market excited or trip a market up is when we get information that was unexpected, either good or bad. And so earnings season can kind of be a little bit of a wild ride, and so that's where we are right now. Now, talking about earnings, we remain significantly diverged from valuations and corporate earnings. And so when we talk with our clients all the time, we say that while the stock market is not necessarily the economy, it is tied to corporate earnings. And so where we are right now, we are really at a place in time that we've never seen. And so this blue line here is the S&P 500 return. The yellow line here is corporate earnings. And so typically we trend pretty close to one another because remember, valuations of the market should be tied to the underlying earnings of that investment. Now we can see back in the early 2000s, we had a significant divergence here. And so there's only two ways to correct a divergence typically. One is that when we're as diverged as we are, the S&P 500 valuations need to fall to come closer to earnings. Earnings need to significantly increase to meet the S&P, or the S&P can kind of trade sideways and stagnate for a while corporate earnings have the ability to catch up. So I guess there's really three, although typically what happens is that S&P valuations fall sharply to meet up with earnings again. So we ran extended for some time, and then obviously the dot-com bubble burst, and so we saw then we were trending very closely to one another until the next significant period of time back in 2009 with the financial collapse that we went through. And then after we recovered, we've really just been on this upward kind of momentum trajectory, but corporate earnings really has not followed suit. And so we see that we have this pretty significant divergence. Now, when we saw our sharp reversion back last year, many analysts began to wonder, okay, so is this it? Are we finally kind of reconciling? But no, we just earnings kind of dropped off and the S&P continued to rocket up towards the moon. So just to kind of give the backdrop of the fact that, because we're in earnings season, so I thought it made sense to talk. So remember, eventually these two will matter. Now we can run extended for a significant period of time. And by a significant period of time, I mean we can run extended for years. So, I mean, it happened last time where we were here, and it's kind of like, they don't matter until they do matter, is basically the point. So just wanted to kind of touch on this about where we are with that, since we're talking about earnings. Now, something very important that happened, that came out today, Tuesday the 13th, that we were waiting on, was the CPI came out, or the Consumer Price Index. And so these were really important numbers. So we've been kind of anxiously awaiting these numbers to come in, because we have seen some volatility in the market, particularly in February and March, relating to rising interest rates, inflationary pressures, and kind of what that has meant for the market, especially for companies who, when goods become more expensive, when it becomes more expensive to borrow money, these will drive expenses up, which means corporate profitability can go down. So it makes it harder to justify our increased valuations. And so we were waiting for the CPI. So CPI is kind of like the proxy for inflation. And so we were expecting to see that CPI would rise, and you would expect that because last March, we were just coming out of having shut the entire economy down. There were significant virus fears at that point. And so we expected, CPI dropped very low in the first quarter of 2020 and also in the beginning of 2020 second quarter. And so we would expect that now, as we have vaccinations happening, we've seen significant stimulus kind of flow through the market again. We have the economy continuing to reopen, and it seems more like kind of consumer sentiment continues to increase and improve, be positive. So it was not unexpected. So the CPI for the month of March did go up 0.6%, just slightly higher than what was originally projected at 0.5%. And then CPI is up 2.6% year over year. So from March last year to March this year, again, not unexpected. We would expect to have seen a sharp increase following March of last year. So why is this number so important? So CPI is very important because it really gives us kind of like a pulse in terms of the economy, about what's kind of driving prices and what can we expect for prices moving forward. And so of that 2.6% year over year, about half of that, of the 0.6% for the month of March, half of that was likely attributed to a sharp increase in gasoline. Gasoline was actually up 9.1% for the month of March. And so, there's quite a few different reasonings that are behind that drive. But we see, and so when it becomes more expensive to ship things, that's going to automatically cause increased expenses. And so we know that the stimulus packages that we've seen have absolutely helped to kind of drive inflation, because it kind of right away kind of gives like an injection of excitement back into the economy, where people are going out and hopefully using that to buy things. And so what we were looking at, and maybe, a note of caution, is markets have been very exuberant over the fact that the Federal Reserve this entire time has been very much almost kind of like Santa Claus, like, hey, don't worry, no matter what, we're just going to keep on adding additional liquidity. We're going to give as much quantitative easement as necessary to keep things moving. It's almost kind of like the Fed. I did a video way back at the beginning last spring of the super Fed, and this vision of Jerome Powell just kind of holding up the economy with his hands, like he wasn't going to let anything happen. So whatever needed to be done to kind of hold the economy's hand as we got through this precarious situation, which was the pandemic and the recession. So now, though, so what does the Fed do now? So now we see inflation's kind of starting to run. We're beginning to see recovery. Jerome Powell was on 60 Minutes and said that there are definitely encouraging signs that he's seeing, certainly within the economy, that we might not be out of the woods, but that we're seeing some positive things happening. And so people begin to wonder, well, what does that mean? Does that mean that the Fed, how long will the Fed keep up their interventions? Because if the Federal Reserve begins to extract that liquidity that they've been injecting into the market, they start releasing some of that quantitative easement that they've been doing to kind of help prop things up, that is going to weigh really heavily on markets, because up until now, the fact that I showed you the screen before that the S&P 500 is really overvalued compared to corporate earnings, but nobody really seems to care right now, because kind of like the Fed's created this monster where but we can justify paying for those valuations because of all these other things that are happening, makes it okay for us to kind of overpay for stocks. So if those things begin to go away, I wonder what investors' thoughts are going to be about what we're paying. And so I was really interested to kind of see what the CPI number was going to be. And so what we know, though, is as CPI increases, and it likely will continue to increase throughout the summer, cost of goods will begin to go up as demand increases. I mean, that's just supply and demand 101 with economics. And so there's a couple of examples that we can even see now. So if you go out and try to buy a used car right now, they are crazy expensive because there's a huge shortage right now in semiconductors for new cars. So the new cars have really slowed coming off the lot. So if you need a car, people are going to used cars and they're paying way more than what you would have paid a year ago. Another example is the cost of boats right now is absolutely astronomical. My husband and I, we are boaters. Well, we were boaters for a while. We don't have a boat right now. A couple months ago, we kind of toyed with the idea of, maybe we would look into getting another boat. We started looking, and the price to buy a used boat right now is absolutely incredible. Our old boat that we sold like 3 or 4 years ago, we actually found the boat that we sold. It was listed for like $20,000 more than what we sold it for 4 years ago. It just absolutely crazy. You can't justify the valuations, but there's demand for the product. They can't make new boats quick enough to come off. There are month waits to order a new boat, so you have to buy a used boat. COVID-19 has just driven up that demand. People said, I'd rather just social distance on a boat or be able to get on the water. We can't travel yet, whatever it is. And so supply and demand, here it is. If you want to buy a used boat, you're going to pay significantly more than what it's probably going to be worth in a few years. But that's kind of like the same idea. So as restaurants continue to open, hey, that's great. But if the cost of food increases, and that's likely going to happen based upon, fuel prices rising. It's going to be more expensive to transport the food. Restaurants are going to have to increase their charges to kind of account for the fact that food is more expensive. As we begin to travel more, the cost of fuel is going to go up because we're going to be consuming more fuel. So you remember last spring, fuel prices dropped. I mean, people weren't going anywhere. I mean, the insurance companies were literally giving us rebates back on our car insurances because people weren't going anywhere. Car accidents were like at an all-time low because, again, we were all staying home. And so we're now consuming more fuel, supply and demand. It's going to increase the cost of fuel again. And so what will eventually happen here is that the Fed, at some point, as inflation kind of runs, they are going to have to actually begin to raise interest rates to help slow that inflation that's happening. So that will be great to kind of rein in inflation, but then markets are really probably not going to like that, because if we have to raise rates, it's going to make very unfavorable to borrow money. And so what markets want, they want to see all the liquidity in the world. They want to see low rates so that they can justify the valuations that they're paying for right now. So that's just a note about CPI. I thought it was interesting. Those numbers, again, they came out today. We were eagerly kind of waiting for them. It's good news, nothing really unexpected. They just marginally beat what the expectations were for CPI. Had those numbers been really over the top, I think markets would have probably been super concerned, but they really weren't. So something just to think about. So I just kind of want to get into, we haven't done this in a while, go over maybe one of our funds. So we just talked about the fact that we're seeing a lot of kind of like discretionary spending increasing, and so that's really exhibited here in our consumer discretionary fund. So I wanted to kind of just show you where we are with that fund, because it kind of ties into everything that we were talking. You can kind of see how this so directly affects one of our investments, especially if you wanted to be involved in consumer discretionary. So this fund has just been absolutely a rocket. Year to date, it's up almost 19%. So January to today, up almost 19%. Fund score of 5.74, best you can be is a 6. And so we have, from a market relative strength, it's positive. Overbought, oversold, though, it's only at 43%, so that's actually a pretty healthy number still. So this fund still definitely has some room to move. And just to kind of show you here, I mean, this thing, it has just been a rocket ship in terms of going up. And this is one of those funds that really got beat up really hard at the beginning of the pandemic last year. And this was kind of one of our recovery plays that we found very early on, thinking that as soon as we began to kind of see a turnaround and that in the economy and that people were willing to go out and buy and spend, and especially as the economy opened up, that this would probably be a really strong play, and it has been. So just wanted to we haven't gone through one of our funds in a while looking at the math and rules that we use to evaluate our funds. So that's what I wanted to get into today. Today was more of a fundamental analysis, but you know, our investment committee likes to say that, you know, we look at fundamentals kind of along with technicals, like playing the piano. They kind of both work together to make the music. So while we make our decisions based on the math and rules of the technicals, fundamentals are important, and so we kind of use them as a lens to view some of the information that we see. So thank you for joining us today. I'm Ashley Rosser. If you have questions, you can always email me, ashleyr@victoryfiduciary.com. I'm always happy to take your questions, comments that you have, ideas for next week. And so thanks for joining us, and we'll see you next week.